Hello, my name is Jessie Rick-Chambers, and today I'll be presenting a summary of the article Understanding Van Camp and Pereira, Apportionment of Separate versus Community Property, written by Mark Kaplan. The central issue addressed by this article is what happens when a business owned by one spouse before marriage increases in value during the marriage. The law requires that this growth be divided between the original separate property and the community property efforts that contributed to it. The two main legal formulas for this apportionment are called the Van Camp and Pereira methods. The Van Camp method applies to valuable capital businesses, those that rely on assets like machinery, inventory, a large workforce, generally like equipment, items, that kind of thing. The most important question to consider is whether the community was fairly compensated for the extensive work that they contributed. It's essential to examine not only the financial compensation, but also the value of their efforts and impact of their labor on the overall project. The formula is extremely simple. Reasonable compensation minus actual compensation equals the community property interest, if focused on compensating labor, not the business's total value. So the article provided a clear example. If a spouse's reasonable compensation is $75,000 a year, but they only take home $30,000 in a salary, the community is underpaid by $45,000 each year. Over a 5-year method, the community property interest in the business's retained earnings would be $225,000. The Pereira method applies to personal services businesses where the owner labor is the primary income source, like a solo law practice, a doctor, an accountant, that kind of thing. This approach treats the initial value of separate property as an investment, warranting a fair rate of return over time. This means that not only does the property retain its original value, but any earnings or returns accrued from that investment also remain classified as separate property. In essence, both the original assets and the returns it generates are safeguarded, ensuring that they are kept distinct from any communal or marital property. This method seeks to protect the financial interests of the individual who contributed the separate property by recognizing its potential for growth and ensuring that any increases in value are equally considered separate. Any value growth beyond that is considered community property. This method requires a formal business valuation. So the article's example shows a business that grew from $100,000 to $250,000 over a 10-year marriage. Applying a reasonable rate of return, say around 6%, the separate property share is between $160,000 and $179,000. The remaining $70,000 or $90,000 of growth is apportioned to the community. So one important insight from the article is that the court possesses discretion when making decisions. This is pretty typical across the board. This means that judges have the authority to interpret the law and apply it in a way that considers the unique circumstances of each case, allowing for a more tailored approach to justice. The flexibility inherent in this discretion can lead to varied outcomes depending on a specific detail or the context of each situation. According to the case Beam versus Bank of America, a court is not forced to choose one method over the other. They're not strictly bound to either Pereira or Van Camp, and can use whichever method or even a blend of both that they believe achieves substantial justice. This means in practice both methods often need to be calculated, as the choice is not always clear-cut. In summary, Van Camp and Pereira provide the legal rules for dividing the growth of a separate property business. Van Camp focuses on fair compensation for work, while Pereira focuses on a fair return on investment. The selection of the appropriate method is a critical and often disputed part of a divorce case, ultimately decided by the court. From this article, I learned that the logical distinction between capital-intensive versus labor-intensive businesses is just the starting point. The most significant takeaway is the court's flexibility, as seen in Beam versus Bank of America. The law is designed not to be rigid, but to allow a judge to use the tool that creates the fairest outcome. This also shows how crucial expert testimony is, as the results depend entirely on what is deemed reasonable. We just had the presentation about defining reasonability, which made me laugh about my article discussing how crucial reasonability is. If I could change or add one thing to the article, it would be to include a clear example of a single business and demonstrate the dramatically different results and financial outcomes produced by the Van Camp calculation versus the Prairie calculation. This would really highlight the high stakes involved in these apportionment cases. I would also like to see an example of hybrid scenario that the article stated that could be condoned. It wasn't in there, and I was really hoping to be able to see that. So this was my summary on the article named Understanding Van Camp and Prairie, Apportionment of Separate versus Community Property by Mark Kaplan. Again, my name is Jessie Riggs-Chambers, and I hope you have a great rest of your day.